Okay, hi everyone. Welcome to the Advanced Mortgage Solutions podcast. This is a podcast that assists people with their property journey, whether you're a first home buyer or a seasoned investor. We cover all topics. I'm Joel Sadler, and our mortgage expert and founder of Advanced Mortgage Solutions is Scott Miller, and he's been in the game for over 20 years. He has a professional background in logistics, management and finance, but obviously a lot to do with property as well, as an investor himself, but also as a mortgage advisor. This podcast is a way for Scott and AMS, which is short for Advanced Mortgage Solutions, to give back to the community and just really with videos and knowledge. Knowledge is power, particularly first home buyers that are looking to get in the market on the ladder. So yeah, buckle up, put your seatbelt on and enjoy. So recently we've noticed that there's a big increase in people looking for interest rates and home loans, and it may signal the start of the summer property season. It's been pretty quiet lately, but it's looking to start to pick up. And when we see search trends increasing, it means obviously there's been a few OCR announcement rates, which is basically where the mortgage rates for home borrowing is coming down. So that stimulated a bit of interest as well. So today, Scott's going to speak to that. So Scott, look, bearing in mind, it's October 2025, as we mentioned, the OCR has announced some rate cuts. What are your thoughts on, where we're going with rates and over the next year or short term, long term?
Okay, obviously a very topical question, particularly at the moment. I'd like to start by saying that this is probably my sixth or seventh, I should say, property cycle. And property cycles generally follow interest rate cycles, as you've alluded to. And the unusual thing about this particular cycle is that we in New Zealand have started to experience lower rates through OCR drops for well over a year now. And what you would normally find is as soon as interest rates start to drop, interest in house prices, houses go up, house prices go up, all the things that are associated with getting into a mortgage becomes cheaper, so more people are looking. And here we are, well over a year since the first drop. And as you alluded to, there's just not that connection between a mass interest on the market right now. It is picking up. It always does at this time of year. Just people use Christmas as the finishing line. It's just always the way, longer viewing hours and better weather and the birds are chirping and, the houses are looking as good as they possibly can. And so a lot of vendors that are looking to sell wait for this time of year because they know it's the best time to sell. Coming back to your question about interest rates, we got a 0.5% interest rate almost 2 weeks ago. The banks had pretty much pre-priced that discount into particularly their 1 year rate, so it dropped from around sort of 4.89%-ish to around 4.49. So a good 0.4% drop there out of the 0.5 that they received. Looking at some of the chief economists around the country and what they're mentioning, they're certainly indicating there's a good chance of a 0.25 drop on the 26th of November this year, and then even possibly another 0.5. And the reasoning behind that is just really pointing to a pretty flat market out there in New Zealand across all sectors, spending, housing, clothes, food, the whole sectors are just a bit flat compared to where interest rates are and where we are in the sort of the cycle pre-Christmas. So interesting times, and obviously a good time to snag a really good rate.
Yeah. So you mentioned banks pricing it in. So as a first home buyer, for example, listening to this podcast, what does that even mean? Pricing stuff in. So can you explain us?
Yeah, sure. So the banks, have spent a lot of money predicting their own forecasting and things that are going to happen. And they have a very large focus on what they believe the Reserve Governor is going to say on the official cash rate announcements. They do happen every 6 weeks, always on a Wednesday at 2:00. So it's well known when, the sequence of OCR announcements are coming. And then with that, the rates that are forecasted by the bank's own chief economist then can lead the bank to say, well, in preparation for what we think is going to be said at the official cash rate announcement by the Reserve Bank Governor, we're going to drop our rates in advance of that conversation, in advance of that notification or announcement, and pre-price the drop that we believe is going to come. There's a wee bit of risk in it, I suppose, if the Reserve Governor then doesn't go and say what they predict they're going to say. And then
Mm.
other times where it's a bit more of a knife-edge decision. They don't know really if it's going to stay or go down or go up, depending on where we are in the
Mm.
interest rate cycle. They usually just hold off, wait for that announcement, and then process that and change their rates accordingly post the announcement. But to pre-price, it's not unusual for that to happen.
Right.
And it just means that the announcement happens and there's no further drops in rates because they've already dropped the rate in preparation for that announcement. And that's certainly what happened on the 8th of October this year.
Right. And is that them trying to get a jump on their competitors, basically going, hey, we're first to market, hopefully people will knock on our door for a home loan sort of thing? Or what's the point of the banks
Yeah, I suppose so.
moving early?
Being first to market is
Yeah.
always something, look at us, look
Mm.
at us. What you will
Yeah.
find is the other banks don't want to be out of step and will match that pretty quickly.
Yeah.
Every bank sort of has their day in the sun of announcing something first, but then the others say, okay, now that that's happened with, Bank A, we're going to have to go and do that ourselves. So we're not, sort of discouraging or putting our particular customers at any kind of downside to what other banks are doing. Yeah.
Yeah. Nice. And these days, I remember back in the day, a broker, now a mortgage advisor, just like yourself, could sort of negotiate with banks around rates and stuff like that. It seems to be now that a lot of that's automated, where they just sort of go, hey, look, these are our best rates we've got available. How does that part work at the moment?
Something that was always a bit of a bugbear, really, because,
Mm.
if a particular applicant or couple or homeowner wasn't aware that they could get a lower rate than what was being advertised, quite often they'd just pick a rate and think that was it. So we put a lot of, when I say we, the broker community as a whole, sort of asked a lot of the time, hey, can you be sort of more upfront with your discounts, just so, what you're seeing on your internet banking is the best rate that's possible, rather than the ability to then negotiate further. And 3 or 4
Yeah.
years ago, there was a shift to that model. And now what you see
Right.
on your internet banking is very honed into your particular situation. And it's usually modeled around the loan to value ratio, which, in simple terms just means how much deposit did you put down to buy the house. So, for example, if you have more than a 20% equity share in your home, then you're going to get the biggest and best discounts that particular bank can offer. And as we've just alluded to, that's not going to be really out of step with what anyone else is offering, because the banks want to be seen to be doing the best for their customers.
Right. Interesting. So there's a bit of sort of public pressure, I suppose, or market pressure on
Yeah.
them to be fair,
And
for
I
want of a better
suppose
word. Kind
if you really wanted to dissect it one step further, they're being upfront and everything on the fixed rates, but there is a little bit of discount to be had on the floating rates. It does depend on, what's happened in the market, the cash wholesale rate of the day. So we can get up to about 0.4 off the floating rate on most days
right.
on the advertised rate. But on the fixed rates, yeah, pretty much now what you see is what you get, and they're not going to discount further at that stage.
Interesting. Okay, so changing tact a little bit. The other question, if I was looking to buy a home in this market, would be, man, how long do I, as you just said, fixing, how long do I fix for? Do I fix for a year and wait for it to come down, that extra, in the hope that it's going to come further down? Or what are your thoughts at the moment on where we are in the cycle and how that might unfold?
It is a crystal ball, right? So,
Yeah, I was going to say, get out your
yeah,
crystal
that's
ball.
it. And we,
Yeah.
as financial advisors, we get hounded, for the lack of a
Yeah.
better word, from every bank telling us what they think's going to happen. And then, of course, the Reserve Bank come out with their commentary as well. So it's really well informed, but it is something that's going to happen in the future. So, look, I was surprised to hear the rhetoric, particularly today, saying that there's a pretty good chance of another 0.5 drop on the 26th of November. And what that leads me to believe is that because New Zealand started dropping rates over a year ago, what we've found, the world as a whole, is really their central banks are only just starting that process. And because New Zealand's just a cork on the ocean of finance, we just bob along and sort of do what everyone else does because we're so small in the financial sense. What I feel is that we're going to have low rates for quite some time while the rest of the world sort of catches up. if you can sort of imagine the world economy is in a bit of a tank at the moment, and they're going to try and lower rates to encourage spending and all the good things that come along with that. There might be some quantitative easing again, some printing of money, particularly on government sort of projects to sort of, again, stimulate employment and spending and all those sorts of things. And because the world is only just really starting that process, you may find that we have an extended period of low rates. Now, after saying that, I certainly don't advise my clients to fix in for any longer than 12 months at the moment, just in case there is a change. And it gives us that opportunity to pop our head up in 12 months' time to see what the ground is looking like at that time. The reason why I don't like longer than 12 months is, 18, 2 years, we may be getting a little bit too close to the next interest rate phase that's starting to increase again. And we certainly don't want to be past that, that curve going back up and not getting the best rates we possibly can. And then that conversation at that stage is completely different. How big are your loans? Do we split them? Do we put them over different terms to protect you through the process of interest rates going up? So, look, at the moment, strong sort of point towards the 1 year, and largely because the 6-month rate just really isn't competitive enough to be an option right now.
Interesting. Yeah, and that was going to be my next question. So it was a nice segue there where you mentioned, splitting up your loans into multiple portions to kind of hedge, I suppose, a little bit. Do you want to explain a little bit about that strategy there? And it sounds to me like it's more as interest rates are starting to turn and maybe rise, you can play a bit of strategy in that piece. Would you give us a bit of a run over how you might, for example, do that?
It's pretty easy to visualize if I use this example. So we've got a $500,000 loan, just one loan of $500,000. We locked that in for, say, 2 years. Within that 2-year period, interest rates have started to increase. It means when that natural term rolled over, so the 2 years comes to its end, we're into a period where interest rates have gone up and we've got one whole $500,000 loan. That's a lot of money to be affected by higher interest rates. So what we typically do is try and work out when we think rates are going to go up, make sure we're not fixing past that point so we can have that discussion before rates go up, split the $500,000 loan possibly into 2 loans, maybe $250,000 each, or 3 loans if you want to. There's no limit, but it gets a little bit silly if you have, $10,000, $50,000 loans and split them over. That's just getting a bit too heavy on the old paperwork and things that you have to do. But let's say you split it in 2, and we might put $250,000 on a 4-year term and the other $250,000 on a 5-year term. And it just means even if interest rates go up, when it comes to the renewal, we're talking about a smaller amount of money, not $500,000. We're talking about $250,000, and we've staggered them so we give interest rates a chance to recover by the time the 5-year rate comes up for renewal. So these are the sorts of simple things that people can do to protect themselves from interest rates going up. It's certainly not a conversation we're having at the moment because we're still riding the interest rate curve to the bottom.
Nice. Yeah, that makes a lot of sense. Yeah. And then, what are your thoughts? I mean, again, this is a crystal ball sort of question, but it seems to me, do you think we're at the sort of bottom of the cycle at the moment? I've been reading a lot online that people think we are, and it is starting to turn, and interest rates may, as they're dropping, sort of stimulate the cycle, as you mentioned. But as you said, it's been kind of happening for a year. We're a bit of a lag. What are your thoughts on the overall sort of property cycle?
There's 2 different cycles we're talking about here, really. The interest rate cycle itself hasn't finished yet. I think if we get a 0.5 drop next month, I would strongly suggest that that's going to be the last drop we're going to see because we're getting really into low digits already. And there'll just come a point where lowering the rate any further won't have any advantage. That, you know what I mean? It's not dropping from 20% to 10%. It's dropping from, 4% to 3%. So it's not going to have the same impact. So that's the one cycle that we're talking about. That hasn't run its full sort of process yet. And like I said, the world's catching up with that process as well, which I think will drag it out a little bit longer for us. That's a good thing. It means lower rates for longer. But now I think what you're alluding to in your question is, where are we in the health of the country kind of cycle?
Oh, is it from a buying point of view?
Yeah, that's right. I do believe, the cost of living is beginning to turn. I'm not saying it's solved and we're all going to, be rich. but it's certainly beginning to turn. We're seeing some increases in tourism and some increases in spending. Only small, but, it's been better than what it has been for the last sort of year or so. So, yeah, in that regard, I do think that particular cycle is finding its bottom and will get some way into the good times again over the next 3 or 4 years.
Yeah. Awesome. All right, Scott. Well, just to wrap up, any final thoughts for our listeners on the whole interest rate discussion and before we, provide your information?
There's a lot of misinformation online. So, the advent of, AI and things like that, it is very fallible when it comes to that very specific type of, instruction or advice around something that I wouldn't put a lot of sort of trust in at this stage. So go to your professional advisor, because they're going to know a lot more than the AI or Google or whoever you go to look online to tell you, for your particular circumstance, this is the best thing to do for you. I just can't advise that strong enough.
Yeah, 100%. I think that's true for any industry, for business owners, entrepreneurs, home buyers, seek expert advice, expert help. And I imagine you'd work in with the client's lawyer or accountant or whoever you might need to work in with as well to make the process smooth.
100%. Yeah.
Yeah, awesome.
Yeah, look, we're all on the same team rowing in the same direction. So it's important to have that experience and that team on your side when you're looking to purchase a house, particularly if it's your first house, because you don't know what you don't know. As you get a little bit more experienced in buying houses, then you can sort of rely a bit more on your own knowledge. But initially, get out there and get the professionals. Yeah.
Brilliant. Oh, well, thanks, Scott. If someone's, listening and they want to reach out to work with you, what's the best way for them to make contact with you and your team?
Everything's on the website. We pretty much finish our webinars with this little hook, but, it's all there, phone numbers, calculators, information. It's all there to have. It's all free, and you can book meetings with us there as well.
Fantastic. All right. Thanks, Scott.
No problem.
Appreciate your insights.
Yeah, all good.